If you own or plan to buy a rental property in Boston or anywhere in the Northeast, understanding the difference between being a passive and active real estate investor could mean the difference between a few $1,000s in write-offs and literally wiping out your entire tax bill in 1 year using advanced strategies like cost segregation and bonus depreciation. In this video, I'm going to break down exactly what it means to qualify as an active real estate professional for IRS purposes, how to actually meet those requirements, and why it's one of the most powerful tools for building wealth with real estate, especially if you want to unlock the full benefits of tax-saving moves like cost segregations. By the end of this video, you're going to know exactly what the IRS looks for, how to tell if you or your spouse might qualify, and how this one decision can help you save tens of thousands of dollars on your taxes, potentially letting you offset W-2 income, business income, or even your spouse's salary. My name is Jarrett Lau, and I own over 50 plus cash flowing rental properties here in the greater Boston area. I work with investors all along over the Northeast, and the one thing I see again and again, most people don't take full advantage of the tax code because they don't understand the difference between a passive and active status. Let's fix that right now. So here's the tax secret most investors miss. The IRS treats rental property losses very differently depending upon whether you're passive or you're active. If you're classified as passive, rental losses, including from powerful strategies like cost segregations and bonus depreciation, can only be used to offset passive income. That means you can't use those write-offs to reduce your W-2, your business income, or your spouse's salary from a regular job. For most investors, this creates what's called a suspended loss. Unused deductions that just sit on your tax return until you have more passive income or until you sell a property. But if you qualify as an active real estate professional, the rules change completely. Those same losses can be used to offset all types of income, even your full-time salary, your business profits, or perhaps your spouse's W-2 income. This is where cost segregation goes from a nice to have to a wealth building machine. I've seen clients and colleagues wipe out 6 figures in taxes in a single year, all by qualifying as an active investor and stacking up cost segs and bonus depreciation. So how do you qualify as a real estate professional? There are 2 main tests, and you have to pass both. First is the 750-hour test. You need to spend more than 750 hours in the calendar year materially participating in real estate activities, managing, acquire, leasing, rehabbing, or selling properties. These hours have to be real, documented, and related to actual hands-on work, not just thinking about deals or real estate reading. Second, the more than half your time test. The time you spend in real estate has to be more than half of all the work that you do in a year. If you have a full-time job outside of real estate, it's very hard to qualify unless you cut back or shift your main job. And here's the huge advantage for married couples. If you file jointly, only one spouse has to meet these requirements. So if your partner is a full-time real estate agent, broker, property manager, or investor, and they hit that 750-hour threshold, and it's more than half of their work for the year, the IRS will treat both of you as an active for all the jointly owned properties. That means both your incomes, all of your rental losses, and all of your write-offs can be stacked together, maximizing your tax benefits and savings as a household. What counts towards these hours? Activities like negotiating leases, handling repairs, managing tenants, overseeing renovations, buying or selling properties, and even hands-on property management all count. What doesn't count? Purely investment activities like researching deals you never buy or time spent as a limited partner with no active role won't help you qualify. Quick but important disclaimer. I'm not a CPA or tax attorney, and the rules here are complicated and always evolving. So you should always talk to a qualified real estate CPA before you make any decisions. You'll need to keep excellent records, log of our hours, details on your activities, and supporting documents, because if you ever get audited, the IRS will absolutely want proof. If you want my checklist for tracking real estate professional status, or if you want to see if you might qualify based on your situation, just comment active in your city below or DM me directly. I'll send you my tracker, a breakdown of what counts for the IRS, and a special tip sheet for married couples who want to leverage one spouse's real estate career for maximum family tax savings. Subscribe here for more advanced Boston investing strategies, and in my next video, I'll cover the biggest mistakes people make when they try to claim active status. so that you can avoid costly IRS audits and keep every dollar that you deserve. I'm Jarrett Lau, and I'll see you in the next one.